Thank you, Professor Ito. So Professor Ito just mentioned that Adam is next. So we have a keynote lecture from Dr. Adam Back, co-founder and CEO of Blockstream. Adam, please.
Okay, thank you, Joey, for the introduction, and thank you, DG Labs, for inviting me to speak. I'm very pleased to be here and talk with you about blockchains. So I'm going to jump right into comparing the properties of blockchains with the existing legacy or the existing banking systems and compare the properties that we get from them. So blockchain is basically building from the Bitcoin technology and extending that to see what we can do with it in the financial systems. So we're hoping that by deploying this technology into the financial networks, we can introduce sort of the kind of internet pace of innovation that occurred with the introduction of the internet a couple of decades ago, see that kind of pace of innovation in Bitcoin, in the banking networks. So if we look at banks, it's based on trust and a reputation of the bank. So when you buy a financial instrument, you're very concerned that the bank has a good reputation and will be in a good state of finance for the duration of the instrument. Now, with blockchains, we get some kind of machine automated integrity. So what in the banking world is based on accounting principles, so an annual audit, a quarterly audit, an inspection of the books, in the blockchain world becomes a machine automated real-time audit, so that every transaction you receive comes with it some kind of proof that the books balance immediately on receipt of the transaction. Banking networks are private, so this is for security reasons. They're using leased lines, private networks, physical lease lines, or virtual private networks. And the blockchain, on the other hand, is an open internet protocol, so the transactions can safely happen over the internet. So the reason that banks are using private networks is the protocol is not secure enough to put on the internet. Basically, the balances in a bank account are just records in a database, and auditors will go through and do reconciliation and check that things are correct. But you are vulnerable to somebody inside the system who would edit this information, and occasionally it happens. So there was an attack on the SWIFT network, and last year there was an attack where an Indian bank their IT systems were compromised, and somebody added $40 million to some prepaid cards, and that wasn't detected for a little while. So the blockchain, on the other hand, is an secure protocol, so the transactions can be broadcast over the internet safely. So one of the other properties with banks is that if you want to make a new application, a new prepaid card, a new internet application that accepts payment, you need to go and ask permission, negotiate with the bank for a contract to interface with their systems to gain access to an API. Whereas with a blockchain, it's permissionless. You can, just like with the internet, have an open API and start writing your application. So we think that by having open access to financial APIs, we'll see a faster pace of innovation. And certainly things seem to be moving very quickly in blockchain and in the Bitcoin world. Another property with banking transactions is the fees can be high. And this is in part because the banks have to work hard for many decades to achieve a high reputation, and there are costs to governance, maintaining audit, and basically there's a high barrier to entry. So they're able to charge a fee, and people will pay it because they're willing to pay for the reputation. Now with the blockchain, you don't have to trust the third party, the bank, as much. The technology provides a different way to solve that problem, and so the fees are comparatively lower. So now I'm going to compare blockchains with distributed ledger technology. So the difference is basically that distributed ledger technology is a new term people have used for a sort of generic term to describe blockchains. Typically, I believe they mean a blockchain without any proof of work. So more of a sort of more similar to the status quo, where each bank has an IT system with their ledger, and with a distributed ledger, they will be cross-checking each other's books. So conversely, with the blockchain, I'd say the distinguishing factor is there is a mechanism for computers to do audit and to get paid for doing the audit. So there is a financial incentive where independent parties are auditing the books and providing proofs that the books balance in real time. So it's a more open audit system. So with a distributed ledger, often you end up with a situation that if they want to move a financial asset, let's say a bond or a structured product, between providers, it might be covered by a legal contract in order for another financial provider to resell that instrument. Whereas with a blockchain, there is some automation. There's a trustless way to move assets between blockchains operated by different banks or groups of banks. With distributed ledger, the banks may be signing that they've checked each other's books periodically. With blockchain, that's very automated in real time. One kind of the main differentiating feature actually is that with a distributed ledger, it's much more similar to the current status with banks, that an instrument is basically an IOU. So, if you read the fine print of the legal contract of the financial instrument you have, in the event that the issuer goes bankrupt, you may not be the first tier creditor. You may be a second or third tier creditor. And you're also beholden to them to maintain the integrity and ownership. If for some reason they decided to, they could prevent you being the owner anymore. Whereas with blockchains, the assets are sort of tokenized, or the analogy would be a digital bearer asset, so something like a bearer bond, but in a digital form. So that's a technology layer. In the actual usage of, how to track owners, there would still likely be identity and a service provider. So blockchains have to be open. They have to be publicly auditable. And distributed ledgers can be closed, or they don't have to be publicly auditable. But for blockchain, it has to be publicly auditable because we have to have miners and users of the system able to verify the transactions for themselves, and that's where the sort of security comes from. We can consider the blockchain to be a form of narrow AI. So it's general AI means a computer that can learn in an artificial intelligent way, whereas narrow AI means some very simplified form of AI that follows rules but still nevertheless achieves an interesting and positive effect. So it gives us a preview in a way that's implementable today of some of the beneficial effects of AI. So the smart contracts in blockchains, which we'll come onto, are a form of this. So when the blockchain is executing a transaction, it's the peer-to-peer network that is executing the transaction, and it behaves in an honest way that everybody can check. So it's important for blockchains that we should have interoperability. So in the early days of the internet, there were different technologies and things converged very quickly on TCP/IP, but before that there were token ring networks, X25 networks, and other kinds of internet transactions. So with the blockchain, we need to be able to move assets between chains. So if one group of banks is using one type of chain technology, they must be able to securely move the asset to another chain. So it's important that the method to move assets between chains is preserving the trust and security properties of the blockchain, which is the complicated part. Otherwise, we would fall back to the legal agreements to move assets, which would lose many of the benefits of blockchains. And I would say also that blockchains, because they're about automating trust, they deliver most of their value when you're talking about transactions between institutions. if it's all within one institution, they can already audit their IT systems. It's important for transactions across multiple institutions, so the interoperability is key. And once we get to usage of blockchains across many institutions, so that everything is real-time audited, we should get lower systemic risk in the finance system eventually. What causes systemic risk is sort of the risk of contagion from delayed knowledge about which institutions are insolvent or so forth. So blockchain transactions are settle on a kind of real-time gross settlement system that's sort of cash-based, immediately irrevocable, whereas currently a lot of post-trade settlement can take a couple of days to longer periods of time to reach settlement, and that's because of reconciliation, the risk of reconciliation failure. So because blockchains are cash-like, there is no possibility for post-trade reconciliation failure, and that can reduce cost and also ensure that the system is in an integrity, has full integrity at each point of transaction. And the cash-like token is an unforgeable secure token. So if we look at the banking systems, it's based basically on a database record that has a number, which is the number of stock units that this user holds. Whereas at the lowest level in a blockchain, there's a cryptographic token, which is unforgeable and secure in itself. So because of that, we can have a much more open system that it's less vulnerable to even insider attack because the tokens are more advanced and unforgeable. Unlike with the banking networks where occasionally an insider or an attacker will break into the system and edit information. You can't edit unforgeable tokens because it's impossible effectively for cryptographic reasons to forge new shares or new tokens. So I mentioned at the beginning the concept of permissionless innovation. So, several decades ago, when the world moved from closed telephony networks with often monopoly telecom providers in countries, the internet provided an open API where anybody could write applications, and we saw the rapid evolution of many exciting things, including social media, online shopping, online advertising. And in the early days, people couldn't really foresee all those things, but it was clear that the fact that it was open and permissionless and any developer or small company could start making applications was partly responsible for driving that rapid pace of innovation. So by having a more open interface to financial applications, we hope to see that same effect in the financial space. So the technology does allow both closed blockchains and open blockchains, but I think we will find that the open blockchains have advantages in seeing a faster availability of applications, and so gain adoption faster and start to have value from the network effect. So we think there should be a market where there's an opportunity for early adopters to get ahead of the competition, which might be by forward-looking financial institutions that want to be early adopters of the technology, and possibly competition from startups in some areas which are not very well served by existing financial services. So perhaps emerging markets or games or low-value payments, things that are not currently widely possible with financial institutions. So now we're going to talk a little bit about smart contracts and what they mean. So it's about automation of financial instruments. So with a financial instrument, usually it's a legal contract and it's executed on request by the issuer or some financial intermediary. Now with smart contracts, it's machine automated and actually executed by the blockchain itself. So the blockchain is a peer-to-peer network where transaction validators and even power users can themselves check all the transactions and all of the contracts executed correctly. So we end up with a very simple program which defines the rules for, let's say, a call option or a structured product, and the network can execute that. So you don't have to rely on a trusted third party to execute the contract. So that is interesting because currently you would have to trust the back office and the issuer to execute the contract. So there's a trusted party there. Whereas with a blockchain call option, for example, the base assets that it's based on, so if it's a call option between US dollars and gold or US dollars and Bitcoin, the assets which maybe are held by a custodian or issued by a custodian can be attached to the contract, and the blockchain can execute the contract. So as a programmer, you could write that contract yourself and do some security review and check that it's correct, and then you could execute it yourself at essentially no cost, sort of 10 cents or something like that, where for structured products, it's not uncommon for a financial institution to charge 1, 2, 3% of the capital cost of the asset up front. So the fees are quite high for the creation of these, and that should see a lower barrier to entry, so a possibility for startups to issue financial instruments. Now, currently that would be difficult to do because the buyer of the financial instrument would look at the reputation and creditworthiness of the issuer, and they would be hesitant to buy from a startup. But with this technology, you no longer care about so much the reputation of the issuer, you care about the security and correctness of the smart contract and the reputation of the custodian of the underlying assets. So it should introduce more competition and better pricing. So one challenge with blockchains is that they are extremely public. So, and in talking with different financial institutions, it's common to hear them express reservations about using the technology because it's too public. And so in 2013, I proposed a cryptographic solution to this problem, which we called confidential transactions. And the idea there is that it's a bit like VPN technology. So you can use the open internet, but you can encrypt everything that goes over it. So it's possible to selectively encrypt part of the blockchain. So specifically the values, so the number of shares or the number of stocks or bonds or the price of them, that value can be encrypted, and yet it can still remain auditable. So if you recall the miners or transaction validators and even users who are checking the transaction integrity, they need to see that the books balance. Now, using a particular type of encryption, it's possible to still ensure that. And so how that works is that there's a form of encryption, which is homomorphic encryption, that you can still validate addition. So you can have encrypted 5 and encrypted 3, add them together, and check that that adds up to encrypted 8. So you can see that this sum is true, but as a validator, you would have no idea what values were involved. It could be 5,000 and 3,000 and 8,000, or it could be 1 and 2 and 3, and you really would have no idea. So that enables confidentiality for commercial purposes and removes one of the potential barriers to adoption. So we can get kind of the integrity assurances without worrying about revealing too much about our business. So if you were operating a business and paying your suppliers and selling the resulting products, if you were to use a blockchain without this kind of feature, you might reveal to your competition what your profit margin is or how much you're paying your supplier. So another topic for blockchains is what the regulators would think, and I think there's a good argument that regulators should like blockchains, because if you look at the premise of regulation, the regulation is about guaranteeing system integrity, financial stability, consumer protection, and governance procedures for banks who have custody of user funds to protect the users. So what blockchains provide is real-time audit and the smart contracts we just discussed. So it's a system for a priori enforcement of rules. So if you think about the system from a regulator's perspective, it's cheaper and better for society if we can prevent actively prevent some forms of cheating or getting a company to a state where it's insolvent without the public knowing. So those kinds of risks, it's better to prevent them happening than to detect them a year or two later, because by the time you've detected them and fined people, it's too late, and there's been contagion to other companies that lent them money without realizing that they were insolvent. So blockchains provide a mechanism for a priori rules enforcement, and it's entirely possible that we could use that kind of feature to make some smart regulations. So we could impose onto banks, let's say, some leverage ratio limits, which is currently often the case, but we could have the system enforce it so that it would be impossible at the protocol level for them to exceed their leverage ratio, where today the leverage ratio, I believe, is not typically visible until the end of an accounting cycle. So to summarize what the implications of blockchains are, so we're replacing a trusted issuer with a trusted instrument. We can reduce the custody risk. So it's common with banks to have a bank mandate where, let's say, in a company account or a trustee account, you'll require 2 signatures if the amount is over some threshold. However, that decision is a policy decision by the bank. If the bank were to neglect to enforce that, the money could be moved anyway. So blockchains provide a more definitive protection that if the asset is under joint custody, so it's a multi-sig in technology terms, then it's physically impossible to move the assets without permission of both parties. And so we can get to a kind of interesting situation where a bank can help protect your security, but the bank can't spend your money or do proprietary trading involving your money without your permission. So we can get more robust forms of ownership that protect the users from governance failures in financial institutions. So there's some evidence that already some regulators have looked at the question of custodianship and potentially offered lower regulatory costs and overheads to blockchain-based service providers that don't have custody or where the user has partial custody. So the financial service provider in a blockchain sense can't spend user funds. So because there's a technical barrier, then the regulator is less concerned about governance kind of oversight. So we can potentially get to a situation with fewer intermediaries because we're able to automate and write smart contracts that provide some types of services that currently require a trusted intermediary to perform. And as I was saying earlier, if we can re-architect the financial systems to move more and more of the types of financial flows and interrelations between financial institutions and companies into the blockchain, we should ultimately get to lower systemic risk, because you will be given, by interacting with a company, some kind of real-time assurance that they're solvent and creditworthy. Where currently, it might become a business practice to make a request to the company register of the jurisdiction to ask for last year's accounts. That doesn't necessarily tell you so much about this year's situation. So blockchains are very interesting, have lots of potential, but it's very important to have security with blockchains. So it really strongly relies on security. And I think anybody who's been involved in internet security for the last 20 years will agree that writing secure code is hard, and protecting information connected to the internet from compromise or tampering is a difficult problem. And blockchains really rely on that kind of level of security because they are open to the internet. And so one analogy that people have made about the kind of the degree of mission criticality on blockchain code is that it's sort of analogous to reprogramming the flight control system of a jumbo jet while it's in flight. And so it's a situation where established security brands are good, where a track record of no failure is good, and new things without extensive years of testing and proving their security are something to be concerned about. So Bitcoin, it's coming up to 8 years now with no direct hacks of value in the network. So bugs were fixed in various stages, but there were at no time any transactions that were stolen at the network level. So I think in the introduction, Joe Ito mentioned Ethereum and the DAO, and so we can see that more very recent, less tested technologies can suffer security failures because of the lack of sort of extensive multi-year testing cycles and improvements in the security base. So Bitcoin has really taken a quality and testing first approach and done a lot of testing, so much more testing than coding, if you like. And so my preferred approach for building blockchains that we can rely on is to build them based on the Bitcoin code base to retain all of that security investment and extend that to support other kinds of assets. So Bitcoin has also had some, as well as very cutting-edge quality assurance, some formal proofs of code correctness, which is important also. So another question is, this technology is interesting, but can it scale? Can we get to high volumes of transactions and low latency transactions? So I will put it that blockchains can be scaled. We're in internet terms, we're at the early stages of TCP/IP, and in internet terms, there are layers of technology. So there's TCP/IP, and on top of that, we have email protocols and web protocols. So within the blockchain world, there are also layer 2 technologies, and I believe Taj is going to be talking about that in one of the sessions today. So there is there's several proposals in layer 2. There's duplex payment channels, or Lightning is a specific proposal which forms a caching layer and can support very many more transactions, sort of very fast settlement, seconds, sub-seconds, versus sort of more minutes in a direct blockchain, and extremely high volumes of transactions versus the kind of limits of the broadcast. And that works because the layer 2 transactions are point-to-point, so the transaction goes between the sender and the recipient only, whereas the blockchain is necessarily broadcast so that all of the transaction validators can check it and make proofs about it. So surprisingly, it turns out that we can provide all of the guarantees of the blockchain in this point-to-point world, including smart contract support. So the blockchain really becomes more of an arbitration mechanism than a direct transaction mechanism once we have layer 2. There's another technology which is a kind of auditable transaction server. So for extremely low latency, high volume, it's also possible to get most of the assurances of the blockchain in a more conventional transaction server. And there are some future directions as well, so that we can get some of the assurances of blockchain audit without needing to consume as much transaction volume and as much data. So there's something called signature of execution. It's a very new technology. It's only a couple of years old. So it will probably be some years before this could be used in a live system, but it's a very promising piece of cryptographic technology for the future. So getting towards the summary of what we've discussed so far. The real-time audit can reduce the need for trust in third parties and intermediaries. By having financial systems and financial technology with better integrity protections, we can lower systemic risk in the economy. Smart contracts can provide finally secure automation where you don't have to trust the person doing the automation because the blockchain itself can enforce the transaction execution. With encryption, we can overcome the factor that blockchains are currently too transparent. So the encryption feature has been implemented. We implemented it in a library last year, and a number of blockchain providers have started to use that approach. The scalability can be solved, as I described just now, and there are techniques to make blockchains interoperable while providing a very wide level of flexibility for different technology providers and institutions to use different smart contracting languages or different implementation choices and still remain interoperable. So there's some need for network interoperability because the financial system is so interconnected. It's early days, so we don't know yet all of the exciting things people will build with this new paradigm. The ability to write programs that involve money and are executed by a narrow AI in a network is a new concept. So probably in a similar way that some of the internet, things that became popular on the internet were not foreseen, we should see some interesting developments as a result of this technology. So that's it. Thank you.
アダムさん、どうもありがとうございます。
Thank you very much, Adam, for your presentation.